An exchange-traded fund or ETF is a fund that can be traded on an exchange like a stock. ETF typically track an index, sector, commodity, or another asset. Just like there are a variety of mutual funds, there are a variety of different ETFs, each with different objectives. Some ETFs invest in a variety of stocks and bonds. Some replicate the performance of a stock index, like the Dow Jones Industrial Average or S&P 500, and others track the performance for a particular market sector, like technology or pharmaceuticals. Let's look at an example of investing in an ETF. Suppose an investor wants to make a diversified investment that is designed to mirror the performance of a major stock index like the S&P 500. He can choose the ETF such as SPY, SPLG, or VOO. Of course, different ETF will have different fees, which we will talk about it later. So, the investor just need to buy an ETF instead of whole bunch of stocks in S&P 500. So, why do we need to buy index fund instead of individual stocks? This is because the difficulty of invest in individual stocks is much higher than index fund. If we compare the 5 years performance of Apple and QQQ, which track the performance of Nasdaq, Apple outrun QQQ. However, if we compare the SPY and IBM, we will see that SPY outrun the IBM. IBM once a top 10 companies by market cap in 1989. The point I want to say is if we are not able to know which company will have the biggest market cap in next 10 years, then we should invest some of the money into index fund. Warren Buffett also thinks that investors should buy index fund instead of individual stocks. He has instructed the trustee in charge of his estate to invest 90% of his money into the S&P 500 and 10% in treasury bills for his wife after he dies. To replicate the performance of index funds, ETF is one of the most easy and cheapest way to do. ETFs help to reduce the risk in investing, especially for beginner. There is always some risks when come to investing. But what is the risks and where is it come from? Basically, the risks of invest in stock markets came from two sectors, fundamental of companies and macroeconomics. The risks of companies are like accounting fraud, lose its competitiveness, or even behavior of CEO will cause the fall of stock price. The risks of macroeconomics are like Russia-Ukraine war, COVID-19, interest rate hike, or trade war. So, how does ETF reduce the risk? Since ETF include a group of stocks, the risks of individual stock are reduced and create diversification to portfolio. This will reduce the risks from companies. So, the risks from stock market reduce into half. How about the return on investment? Will it reduce into half also? Here is the percentage of US large-cap stock funds that beat the S&P 500 index. We can see there is no more than 50% of the funds that are able to beat the S&P 500 index in the last 10 years. So, with the risks on investing ETF reduced, the return is still considerable when comparing to mutual funds. Of course, ETF will charge a little bit when you invest in it. We can see the cost of ETF over ETF.com. The expense ratio of SPY is 0.09%. Technically, this means every $1,000 you invest in this ETF, the management only take 90 cents, which is super low. While the mutual fund fees typically range from 0.5% to 1.5%. Don't underestimate the 1% difference, it seems like small amount. But when you compound it over a long period, the cost is incredible big. If you invest $100,000 with 6% return over 30 years with 0.25% annual cost, you will get $549,000. But with slightly higher cost at 0.6%, you will lose $70,000 to the fees. The amount is quite big. If we compare the SPY and VOO, both are the ETF that track the performance of S&P 500. The expense ratio is different. VOO only have 0.03% expense ratio. However, the daily volume and AUM, which stands for assets under management, are different also. We can see SPY have much higher AUM than VOO. We should avoid the ETF that have low AUM. An ETF with lower assets is likely to have a limited degree of investor interest. As with a stock, limited investor interest translates into poor liquidity and wide spreads. Here are the 3 things you can reference to when invest in ETF. First, try to avoid the ETF that have less than $20 million of AUM. Second, the top 10 holdings of the ETF must have the good outlook. If you're not looking good for the top 10 holdings of the ETF, then this ETF is not suitable for you. Last, compare the expense ratio. Of course, the lower expense ratio is better for us as investor. The investing strategy also important even investing in ETF. Don't try to timing the market. Many investors don't realize that the stock market's gains for any given year come from just a handful of days of stellar performance. Missing the best 10 days will result in huge difference. Dollar cost averaging or lump sum investing both are better strategy when invest in ETF, because when come to invest in ETF, we should always hold for the long term. Lump sum investing describes investing the total sum all at once as soon as it's available. While dollar cost averaging, or DCA for short, is buy when the stock price fall. But the lump sum investing always outperform the DCA as graph shown. In conclusion, there are so many ETF in the market. Personally, I think the ETF that track the performance of S&P 500 and Nasdaq are the best. Because our goal is outperform index or at least follow the index. If you have other opinions, let's comment below. Please help to like and subscribe.